Good day. So I'll continue with asset pricing theory 1, and I'll be continuing with the second lecture on capital asset pricing model. So in the earlier lecture, we have already seen what capital asset pricing model is, what were the assumptions we have taken, and how portfolio is being constructed by using CAPM model. So just an extension of what we have seen in the previous slides. I'm not going into detail over here because it talks about the systematic risk and the expected return and what are the key components which we used while calculating CAPM was the risk-free rate of return, that is RF, the market return on the individual stock in which I have invested, and beta is the factor of the volatility factor, or the relationship between the various factors and the price change in my particular stock. So that's what we have seen in the previous lecture. Now let us proceed ahead, where I'm talking about this particular capital asset pricing model in a different manner. So first let us see, here I've talked about SML. First let us see what CML is. It talks about capital market line. Okay. So when I was discussing the efficient market hypothesis, we had talked about the efficient frontier. The efficient frontier is nothing but I put risk over here, the return over here, and I was saying that if suppose the amount of risk over here is this, one of the stock which I have identified is this, higher risk, I get a higher return. For the same amount of risk, I may have a lower return. I have a higher risk, a higher return. So like this, if suppose I have, I'm trying to connect these dots, and then I'm saying that this is the efficient frontier within which I can put my money overall. Okay, so I'm just trying to expand this into the capital asset pricing model, where I've told that the x-axis talks about the risk factor, or the sigma or standard deviation, which whatever you call them, and this talks about the return. I've just plotted the different stocks based upon the risk parameters, and I've got this as the curve. Okay, so now in this particular curve, let us assume that this is the risk-free rate of return, and if suppose I am able to draw a line which touches the efficient frontier, this point where it touches, I call it as S. Okay, so RFS is talking about all the combinations of risk plus risk-free assets. So it is a combination of risk plus risk-free assets, and any point below S is something where you are underutilizing invested money. So the return what you are going to get is less than lesser in comparison to any point which goes above the point S. So S is the point what you call as it does not actually represent any riskless asset. So this is the point which does not reflect any riskless asset. Any point which is below this riskless asset is considered to be low risk. Above that, it is going to be high risk. So in CAPM, when I'm drawing, what is happening over here is the premium portion, whatever I'm going to get from this point to this point, is going to be low. And if suppose I'm going to take a higher risk, then the return what I would be getting would be above the average return which I have I am expecting. So S, I can call it as the average return which I would be getting by means of investing in riskless asset and minimum risk asset. So any point between this is considered to be an investment in low risk instrument, okay, and this would be a high risk instrument. So this is what you call as capital market line, okay. So it's a it represents the efficient frontier where the investment has to be made. Similarly, I can also draw CAPM graphically. Suppose I am going to representing CAPM graphically, then I am calling it as SML. SML is nothing but security market line, okay. Security market line. So security market line, again it is done for based on risk and return. I've identified the stock based on different risk parameters in which I want to invest my money, okay. So this is the risk-free rate of return. So this would be the security market line in which I have invested. So if suppose I am going to invest, I do not want to take this much amount of risk, or might be my return is lesser than what I am expecting, then it could be somewhere over here. So, or it could go up somewhere over there. So if suppose a high risk project with a higher return, I can put my money over here, right? And if it is below the SML line, then it is considered to be undervalued stock or low valued stock. So you can go through this, you will understand that if the asset positioned above the line offers higher return, then it means to say that it is undervalued. So this is the normal return which I have expected, but this is the return which actually it is giving. So it means to say that the stock is undervalued. That is why the actual return is higher than the expected return. If it is the opposite, if the actual return is lower than the expected return, then it means to say that the stock is overvalued, which I have already discussed in the previous lecture. But this is talked about in a graphical manner, and that is why it is called security market line. So what does the slope of security market line talk about? Security market line is talking about the market risk premium. What do you mean by market risk premium? Market risk premium is this. What is premium? In the previous thing we have talked, RM minus RF, right? So this is your risk-free rate of return, and whatever excess you are going to get. So this is 0. So this becomes 1, this becomes 2, 3, 4. So whatever is the difference, so that's going to be the premium what I'm going to get. So that's reflected in this particular graph, and that is what is told over here as it represents the market risk premium. And what is it calculating? It is calculating the premium part of my investment, okay. So that's what you mean by the slope over there. And how is beta interpreted and the expected return on security market line? The x-axis is representing beta over here. So here the risk whichever I talked about over here in the graph, this is nothing but the systematic risk, and systematic risk is otherwise called your beta, right? So the risk whatever I have considered over there, is nothing but the beta, and y-axis is going to talk about the return whatever you are going to get. So we are trying to classify the risk into systematic, unsystematic part, and in CAPM model and in SML graph, we are going to depict only the systematic risk. We are not going to consider the unsystematic part over here. The reason why we are not going to consider that is because I will tell you one thing, whatever return I am going to get on my portfolio, whatever return I am going to get on my portfolio is equal to the systematic risk plus unsystematic risk. Okay, you forget the other formula and other things. Systematic risk is derived from the system over which I do not have control. Unsystematic risk is the risk which is coming from my functioning, and I can have control over it. Okay, so I can minimize this unsystematic risk to an extent that it becomes either 0 or almost equal to 0. So that is the reason why we are not considering the unsystematic risk while calculating beta. We are more concerned about the systematic risk, and as beta increases, the expected return is also going to increase, and higher risk assets will give you a higher return. So the graph as it goes high, it is nothing but talking about beta increasing, that is the systematic risk increasing, the return is also increasing. So this is the expected return, and if suppose the actual return is over here, it means to say that the stock is undervalued, and if suppose it is coming out to be here, it talks about overvalued. Beta calculation and adjustment. Now we have already seen in formula how beta is being calculated. So it is done by regression analysis. The historical beta is used to do the through regression analysis, and basically it is talking about how we try to make adjustment over a period of time based upon the various factors as well as the industry average. So in real world situation, what is the limitation of CAPM? It is dependent on historical data, because whatever information is available in the market, that has an influence on the market, and that is where we'd say that it has the assumption talks about efficient market hypothesis and information flow, right? And the second limitation what you have is in terms of the accuracy of CAPM, if suppose the market is dynamic. So dynamic means it changes over a period of time with various informations flowing into the markets. If suppose such situation happens, how is it going to have an impact? Because there are certain aspects which we will consider as we go ahead in this particular module, which talks about dynamic market. Okay. Now, what are the other pricing models which is available in comparison to CAPM and which is used at par, or if not at equally, but these are also considered to be some of the important asset pricing models. One is the APT and the other one is the Pharma-French 3-factor model. So these are the other models which is used for asset pricing, and why these are preferred over CAPM under different conditions is because this actually limits the drawbacks of capital asset pricing model. Okay. So where is CAPM used in corporate finance? It is normally used to calculate the cost of equity, which I told you the module 4 when I am discussing, I'll talk about it, or I might have discussed about it. And while doing capital budgeting decision, I am going to use CAPM as one of the measure for determining mutually exclusive projects or projects in which I can have invest my money in. How is performance evaluation done in CAPM model? It is evaluated based on the portfolio manager's performance, right? And you have a concept of Jensen alpha. Jensen alpha is nothing but it's the difference between the actual return and the expected return which you have derived through capital asset pricing model. Okay, so if suppose the expected return is higher than the actual return, then the excess of whatever you have got is considered to be the alpha, and that's called the Jensen alpha. But without using the term alpha over here, we have already discussed about this, whether the stock is overvalued or undervalued based on these aspects. So in this particular lecture, I have tried to talk about how CAPM has been represented in different modes, that is through the capital market line and the security market line, and what are the limitations of CAPM and how it is being covered by the other asset modeling theories which is available. And we also just touched upon various dynamic factors which we will be discussing in detail in future lectures in the same module. Thank you.